More though on the bond market. We turn our focus now to the John Hancock Strategic Income Fund, a Bloomberg best in the global bond fund category. Over the last 12 months, it has outperformed most of its peers, ranking in the 83rd percentile. Dan Janis is Senior Portfolio Manager at MFC Global Investment Management, co-manager of the fund. He joins us now from Boston to talk about his winning strategy and offer an outlook on the market. And still with us is our own Dom Chu from the markets desk. Dan, great to have you here on Bloomberg. Safe to say this is a tough environment, certainly when you look at the Treasury market at this point.
Right. When we look at Treasuries, I mean, the yield relative to us, since we're an income fund and we're looking at, spread over Treasuries, it doesn't appeal to us right now, but there are other opportunities that we think that we can take advantage of, especially high yield in some emerging market locations. Be
more specific. So that's where you're finding opportunities at this point. Where within the high yield market and other aspects, if you will, of the bond market that you find some interesting opportunities?
Right now, in our high-yield bucket, we're about 43% of the fund, and it's pretty diversified with names between 50 basis points and 150 basis points. Gaming, telecom, and media are our top sort of sector allocations. And we feel that those warrant good cash flows together with good repayment on the bonds, that it makes sense for us to own those bonds.
Hey Dan, it's Dominic here. Really quick, you're not the only manager out there who's taken in inflows in terms of their global or international bond funds. Why is it for our viewers out there that they're so appealing right now as opposed to, say, European or U.S. debt?
When you look at the global landscape, it's a diversifier away from the situations that you mentioned. Also, there's some yield pickup, and in some locations, if you go into the currency-denominated bonds, you can get a currency kick too. So, a diversifier, an alpha generator, and some total return kick there in some of the bonds away from what you mentioned.
Dan, I am curious. The Fed decision yesterday, their meeting, their statement, that's certainly impacting a lot of the financial markets today. How has that impacted your strategy, if at all?
Well, right now with that, it wasn't a surprise. I think it was, a tweaking of the situation, but they did open the door that, they did, I guess, agree that the market has shown some weakness. So by doing that process, I think it's allowed them to open the door to help thwart the weakness. But as far as our strategy, I still think it lends itself to look at spread product, especially in high yield markets and also abroad in emerging markets. So not really a big change. Not really a big change.
I mean, you think it's going to be some time before we see anything significantly different out of the Fed at this point?
I think they're, on hold for a while. They want to keep rates in a range, probably on the 10-year, somewhere between 2.75 and 3.25. I think that until they start to see traction on jobs and traction on some of the other economic indicators, I think we'll be in that range. And as such, we think opportunities on a spread product together with some potential currency situations in emerging markets make sense to us.
Hey, Dan, it's Dominic again. I talked to a couple traders today who basically said, is this justified? Are 2.75% rates justified on 10 years? And is it just possibly perhaps a hedging anomaly that's happening in the marketplace? Or are we, in fact, seeing a reason why yields are so low right now?
Well, if we go back to before the European crisis, rates were close to 4% in the 10-year, and I think it was more of a flight to quality. And now we had a little bit more of economic news probably coming out on the weaker end of the ranges. But to us, we're not, really embracing a 2 3/4 Treasury bond that, we don't think it has much value. Again, we're in sort of spread product where we think we can pick up the incremental spread in the high yield and together with some total return on the foreign bonds.
Hey, Dan, does the U.S. Treasury market make you nervous longer term? I bring this up because Professor Larry Kotlikoff, he's over at Boston University. He's got a story here in Bloomberg News. He wrote a commentary, and he basically says the U.S. is bankrupt and we don't even know it. His point talking about unofficial liabilities and so on and so forth. Is there any real good argument to be in Treasuries longer term here, U.S. Treasury specifically?
Well, right now we don't see any major long-term except just a short-term flight to quality because the real yield here doesn't make sense to us because we have alternatives that we can diversify. If the fundamentals, if we go on a spending spree that is not in check over time, then we could have some problems in the bond market, especially in the government bonds.
All right, and we'll certainly keep a watch on that as we have been. Hey, Dan, thank you so much for finding some time for us here at Bloomberg.